Hello Business 202. This video demonstrates the solution to exercise 1522 on adjusting for fair value for investments. In this exercise you have the Storm Inc. Corporation which purchased various investments: the Dust Devil Incorporated shares, the Gale Company shares, and the Whirlwind Company shares. And here you can see the number of shares in each of these investee or target companies that Storm has purchased. And the total cost at the time of purchase, in this case 2014, was $81,700 for Dust Devil, $68,000 for Gale Company, and $114,000 for the Whirlwind Company. The total cost of all three of these investments was $263,700. These investments are being accounted for as available for sale securities because Storm Inc. does not own more than 20% of the outstanding shares in any of these companies. As a result, at the end of the period, in this case December 31, 2014, these shares all will be marked to market. So our job in this particular spreadsheet is to compare, in the first column, the total cost, which would be $263,700, to the market value, which we have to compute from the information that we have in the two tables at the right, and then the difference will be the change that we will show in an account called fair value adjustment. First, let's get the cost. The cost is easy. All that we must do is to take the cost that you see in the first table and transfer it to the second table. So for the Dust Devil, we will enter $81,700, for Gale Company, $68,000, and for the Whirlwind Company, $114,000. So the total cost, as you see, is, as reported, $263,700. For the fair value, we calculate that by taking the number of shares times the fair value per share, what these stocks are selling for, on December 31, 2014. So in the number of shares column, let's enter 1,900 shares for Dust Devil, 850 shares for Gale Company, and 2,850 shares for the Whirlwind Company. We also want to enter the fair market value per share from Table 2. Each share of Dust Devil is selling for $40 at the end of the period. Each share of Gale Company is selling for $75 a share, and the Whirlwind Company shares sell for $42 each. In the fair value column, what we want to do is to enter formulas that would multiply the number of shares times the price per share to get the fair value of these shares. So you can see the Dust Devil shares, 1,900 at 40 gives you 76,000. For the Gale Company, 850 shares at $75 a share produces a fair value of $63,750. And finally, for the Whirlwind Company, 2,850 shares at a fair value per share of $42 produces a fair value of $119,700. Adding the fair value of each of these shares brings a total fair value for all three investments of $259,450. As you can see, the fair value, $259,450, is less than the cost, $263,700. So the fair value is below the cost, so the company, which has not sold any of these shares, will incur a loss for the difference, $4,250. This loss will be reported as an unrealized loss in the income statement. In other words, it will be reported under other accumulated comprehensive income in the shareholders' equity section of the financial report. Okay, let's make the journal entry for this. The Storm Company has not purchased any shares before 2014, so the beginning balance in the investment account as well as the beginning balance in the fair value account as of January 1, 2014 would be zero. so any change would fully be reported in the fair value allowance account. To record a loss, we would show an unrealized loss from available for sale securities, $4,250. And we would report this as an valuation allowance from available for sale securities. This account would be credited to show that the fair value is less than the cost. Since investments are an asset, they are increased with debit side entries and reduced with credit side entries, so this fair value allowance would be a credit balance to show that the fair value has declined. Now, let's show the effect of this journal entry on the financial statements. The unrealized loss, it's a loss because it has a debit balance account, will affect unrealized capital, or AOCI, accumulated other comprehensive income, and because there is a debit to this credit balance account, we will enter that value as a negative amount. The credit to the valuation allowance account would be like crediting the investment account. An investment is an asset, and if we credit or make a right-hand entry to the left-hand investment account, we would reduce it. So the effect on the financial statements would be to reduce the fair value of assets and to show that the company has an unrealized loss in owner's equity, $4,250. There would be no effect on earned revenues, earned expense, or earned income, and because none of the investments were sold, there would be no effect on cash flow. There you have it. Give this a try. Enjoy.